Welcome back. In this segment, we're going to continue personal investing and talk about investments. This should be a review for most of you. Remember, we talked about your most important financial decision will be to save. Here, we're going to talk about your investment decision. And here, the most important investment decision you will make is your asset allocation. Remember, your asset allocation is the percent of your investments that are in each of the asset classes. Also recall that when we looked at asset allocation, it depended upon what you were trying to save your money for, investing your money. Did you need it now or long term? Long term, you'll remember that the most important or the best investment class was stocks, equities. Yes, they may go down as they are right now, but over the long term, they go back. And if your investment horizon is 5 years or longer, or 10 years, you can and should have equities in your portfolio. Now, if you absolutely have to have that money and it can't go down, you're saving money for an investment or for a purchase, or you need money for emergencies, the best thing to do is put your money into cash. Remember, cash is not just the money in your wallet or your checking account. It can be CDs, money market funds, U.S. Treasury bills, all of those. And if you want money, a regular stream of money coming in, current income, bonds are good, and also dividend stocks. So how you invest your asset allocation will depend upon what your investment objective is. All right, so we know we're going to save. We talked about that in the last talk. We're going to save 15–20% of our money. Now, how should we allocate that money? Most advisors will recommend 3 and sometimes up to 6 months of your expenses should be kept in cash. This is for emergencies. This is not for daily living. This is for emergencies. Once that money has been set aside, a general rule of thumb, now this is just a guideline, it's not a law of physics, but a general guideline is that the percent of stocks that you have, your allocation in stocks, should be 100 minus your age. So if you're young, 20 years old, that would mean 100 minus 20, you should have roughly 80% of your investments in equities. The percent of bonds then would be your age. So again, if you're 20, you would have 20% of your investments in bonds or fixed income. That's not a law. If you want to be more conservative, put more money into bonds. If you want to be a little more aggressive, put your money a little more into equities. It's just a guideline. But it gives you a kind of a starting place to think about where you would put your money in what allocation. All right. Well, now we've talked about how much you should save. You've got a rough asset allocation. Now, which stocks, which bonds should you invest in? I strongly advise against buying individual stocks or bonds. There are a lot of financial people out there who work 6–7 days a week trying to pick stocks to beat somebody else by 1% or 1/100th of 1% even. Those investment people, when they decide to pick a stock, they call it placing a bet. If it's a bet for those people who study these things day and night, if it's a bet for those people, what do you think it's us? What do you think it means for us? These are very smart people. Think about this. Every time you buy a stock, somebody is selling a stock. What do you know that they don't know? Are you smarter than the person on the other side? Or you sell something, somebody's buying it. Are you smarter than that person? I'm guessing the answer is no. What do you know that they don't know? Probably nothing. If you want to play with stocks and bonds, think of it like going to Atlantic City. Set some money aside, small money aside, and go ahead. But that's not where your long-term investments should be. I say careful buying bond mutual funds. Remember that I said that stocks or bond funds that are called high yield, meaning they get high percent of interest, they pay high percent of interest, those bond funds are actually junk bond funds and carry very high risk. So what should you do? Well, we've talked about this before. Buy mutual funds or ETFs. Use the money pooled together from lots of people to buy lots of stocks and bonds. It diversifies your risk. You're not just picking a stock. You're not placing a bet, but you can buy a variety, buy the market. Now, which mutual funds? There's two types. Managed, meaning you give your money to somebody, or lots of people give their money to somebody, and they pick and place bets for you. And you will pay them a lot of money to be able to pick those bets for you. On the other hand, you can buy index funds. These track the market. There are lots of index funds. There are index funds that track the S&P 500, the total U.S. stock market, gold and precious metals funds. You can find energy funds. You can find European index funds, Asian index funds. You can find the total world index funds. You're not paying someone to place bets for you. You are buying a diversified portfolio that matches the market. This is the lowest costs. No sense paying somebody 2% of your money every year just to have them pick losers. Because you'll see that index funds have much lower costs, and every year the S&P 500 alone beats 75% of all managed funds. And really, do you think one manager anywhere is going to consistently beat everyone else? Not likely. There was a fund once, and I don't have the name off the top of my head, that beat the stock market, beat the S&P 500 for 10 years in a row. They were the rock stars of Wall Street. The following 3 years, they lost all of those gains. Their luck ran out. So, in summary, save your money, 15 to 20%. Look at your asset allocation, and then buy index funds to build that asset allocation. So if you're going to be 20% equities, 20% can be an index fund like the S&P 500 or a total U.S. index. If you're going to be 20% bonds, buy a total bond fund. In the next segment, we'll talk about now actually accounts that you would put your money in and where you would save these.